In today's show, we're going to talk about 2023 stock market predictions from some big industry names. Will the stock market continue its downward trend, or is it going to reverse direction and will we finally see an upward trend in the market? We're going to talk about their predictions, what we should plan on, how to plan around all of the volatility that we're seeing, and then opportunities that you should be looking at.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Searens, and my goal is to help you thrive in life, wealth, and retirement. And today's show is all about predictions. Wouldn't it just be nice if we could predict what the lottery numbers would be upcoming, or the winner of the Super Bowl? Wouldn't it just be nice if we knew what was going to happen in our lives later today, tomorrow, 5 years from now, 10 years from now? And as I'm saying all of this, I know what you're thinking. It doesn't happen, doesn't exist. So why spend time and energy focusing on what you can't control? And you're right. Why spend that time and energy focusing on trying to predict the future, something that you can't control? Because when you sit there and try to predict the future, what that creates is potential fear or worry. So we don't worry about that. Well, guess what? Some big names are out with their 2023 stock market predictions, and that's what we're going to talk about today, what they're saying about the stock market for 2023. And as you know, market volatility really became the norm in 2022. And so are we looking for more of the same in 2023? Will the market go up? Will the market go down? We're going to take a look at the market outlook over the next 12 months from some of the big names in the industry. And then really the most important part here, share some tips on how you can best prepare for the future when reality is nobody can predict it. So let's start. What are some of the big names saying about the stock market in 2023? Well, here we go. First is Russell Investments. Now, all of these, I'm going to link to all of the different articles. You can go to lifemoneyshow.com. Again, that's lifemoneyshow.com. I'm going to link to all of the different articles here. And so that way you can read the full articles on all of their predictions and what they're saying about the stock market. So go to lifemoneyshow.com, go to today's episode, and we'll have all of the websites listed there. So the first one is Russell Investments. Now, Russell Investments say equities have limited upside with recession risk on the horizon. They're saying fixed income will make a comeback after experiencing the worst year of returns in 2022. And overall, 2023 is likely to be the year of the diversified portfolio, where a traditional balanced portfolio of 60% equities and 40% fixed income does well. All right, so that was Russell Investments. Now, what I am finding interesting, not a whole lot of people are actually giving numbers. They're not saying, hey, plus 10% or minus 5%. Maybe they're finally starting to catch on that they can't predict the future. But let's continue on. What's our friends from Bloomberg saying here? Bloomberg saying the average forecast of handicappers tracked by Bloomberg calls for a decline in the S&P 500 next year, being this year, 2023. So this is an article from late 2022. The first time the aggregate prediction has been negative since at least 1999. The interesting thing here, if you look at the chart following their predictions, their prediction for last year was positive. So there you go. Take what they're saying as you wish. Next, we have Morgan Stanley. Morgan Stanley says investors should prepare for extreme volatility in 2023 as the U.S. economy steers through a 1940s-style boom-bust inflation. And this is according to Morgan Stanley Chief Investment Officer Mike Wilson. All right, let's continue forward here. We've got J.P. Morgan. What's J.P. Morgan say? Well, J.P. Morgan strategists see U.S. stocks slumping in the first half of 2023. And then a few other bullet points here. The S&P 500 to retest 2022 lows as fundamentals weaken. And then it also says expect stocks to rebound in the second half following a Fed pivot. And then the last one here is from BlackRock. Now, I thought they just had some really interesting outlook and some really great things that they wrote here in regards to just their view on the stock market in the future. So I'm going to read some of it to you, And then, like I said, the full article is at lifemoneyshow.com. So what's BlackRock saying? BlackRock says the Great Moderation, the 4-decade period of largely stable activity and inflation, is behind us. The new regime of greater economic and market volatility is now playing out and not going away in their view. Central banks are deliberately causing recessions by over-tightening policy to try to rein in inflation, and that makes recession foretold. They also said in the article, we expect inflation to cool but stay persistently higher than the central bank targets of 2%. Onward here in the article, it says a key feature of the new regime, we believe, is that we are in a world shaped by production constraints. So that's really interesting if you kind of think about this, and then the trade-off here that they talk about at the bottom. So as we all know, we've been experiencing high inflation throughout 2022, but what they're wondering is this high inflation, is it actually tied to monetary policy, so raising interest rates, will that cool off inflation, or is it tied to production constraints? So I'm going to read you their last paragraph here, and it's just kind of just really interesting thought process. Like I guess you could say in the end, they really didn't make a prediction for next year, but maybe they kind of did. Maybe they're saying, hey, we just feel like there's going to continue to be a lot of market volatility. So the last paragraph here says a brutal trade-off. Central bank policy rates are not the tool to resolve production constraints. So like we're saying, production constraints versus monetary policy, not related. He said they can only influence demand in their economies. That leaves them with a brutal trade-off. Either get inflation back to 2% targets by crushing demand down to what the economy can comfortably produce now, or live with more inflation. For now, they're all in on the first option, so recession is foretold. Signs of a slowdown are emerging, but as the damage becomes real, we believe they'll stop their hikes, even though inflation won't be able to get on track all the way down to 2%. So there we go. We've got Russell Investments not really saying anything other than potential recession risk on the horizon. They do say fixed income, though. They feel like that's making a comeback. Bloomberg is throwing their neck out there. They're saying, hey, they feel like the S&P will have a down year this year. JP Morgan stating that the first half of the year they feel like stocks will slump, but a rebound after a Fed pivot. And then BlackRock calling out just more market volatility as production constraints and inflation continue to figure its way out. So what do I think of all of these thoughts and predictions? Well, first off, they're just predictions. Some of them are going to be right, some of them are going to be wrong. And as we already know, nobody has the crystal ball of what's going to be happening in the future. And here's the deal. They will be wrong. And unfortunately, it'll be okay because we all move on, we all move forward, and nobody just goes backwards and checks on all of these folks that are putting predictions out there to see how right and wrong they were, or who is right on the dot when it came to their predictions. So it makes it really easy for them. I mean, I guess everything's on the internet, but not a whole lot of people are just going backwards to say, were they right last year? And so it just makes it really easy for these companies just to throw out predictions, grab your attention right now, and then move on because they know that you won't go back and check it, or most people won't go back and check it for the most part. So why am I sharing these? As I had spoken from the beginning, if I were to kind of talk to you about, predicting things in your life, like what's going to happen for the rest of the day today? What's going to happen tomorrow? Where are you going to be at in 5 years? Where are you going to be at in 10 years? You're going to say, I have no idea. And you're not going to spend a whole lot of time and energy on that conversation with me because you can't predict the future. You don't know who's going to win the Super Bowl yet. You don't know what the lottery numbers are going to be on the next drawing. So we don't spend time and energy on those conversations. Well, same here. And this is my goal in sharing these and talking about these. As you can tell, they're all different. Some said the market's going to be up. Some said the market's going to be down. Some just said there's going to be a lot of volatility. So the reason I'm sharing this is because we shouldn't, just like in our lives, we can't predict the future. Same thing about the market. So we shouldn't spend a lot of time paying attention to these. We shouldn't get caught up in the news and get caught up in the headlines that are just trying to get our attention, to have us click on them so they can just advertise to us, because that's how they make money. So we don't want to spend time and energy on what we can't control. So what is it that we should plan on? Well, here's the deal. I think you already know this, but every year the market could potentially go up. Every year the market could potentially go down. Every so often we're going to see market corrections. Corrections is where it goes down by 10%. Every so often we're going to have bear markets where the market's 20% off its highs. But more often, based on history, we're going to have bull markets. More often, and the long-term trend for the overall stock market is up. So if you're looking at the month-to-month or the day-to-day, absolutely you're going to see volatility. But if you're looking at the 5-year trends and the 10-year trends and the long-term trends, you're going to see an upward trend on the overall stock market. And I also think it's important to remember what we're investing in. We're investing in companies that produce products to sell to consumers to produce a profit. So we're investing in those companies. And if they're companies that are out there in our world today that are still producing products for a profit, we're also getting a share of those profits. That's what's called dividends. And then the companies are growing as well. And that's the increase in the value of your stock price. So as long as there's companies that are continuing to live out the American dream and serve the American people, I think we're all going to be A-okay. One thing I mentioned is that if you are going to be looking at the month-to-month or the day-to-day, that, yeah, absolutely, you're plan on seeing some volatility. The volatility is that huge up and down swings in the overall stock market values. So what should you do if you're looking for some reason at the day-to-day or that month-to-month? Well, here's some suggestions. One is to focus on your strategy. Whether you're approaching retirement or if you're in retirement, you want to focus on your strategy. What does your income plan say that you're going to need, meaning how much you're going to need to withdraw over the next year, over the next 3 years, over the next 5 years, over the next 10 years? Have you used that to then build your investment plan and your investment strategy? Have you used that to start to carve off a pool of funds not subject to the same volatility of the stock market? So that way, as we do see those times that come where we're having a market correction or we're having a bull market, that you've got your pool of funds carved off, you've got your war chest there for you, so you've got a spot to go to make withdrawals from, to let the other side of your portfolio go through those volatile sessions and rebound back up. But at the same time, you want to have money on the growth side. We need money there to help you keep up with inflation, to last as long as you will. And yes, absolutely, we're going to see volatility on the growth side of the portfolio, but history has shown us over those periods of time, right, that we have more gains on that growth side of the portfolio than we do on that safer side of the portfolio. So first off, focus on your strategy versus focusing on the day-to-day movements of the market. Does your strategy align with your future? And that's, again, whether you're in retirement or if you're approaching retirement, have you started to, build out your strategy so you can focus on that rather than being worried about the market going down just prior to your retirement. Number 2, know where you need to make adjustments. Yes, the market is down. A lot of times when the market goes down, the mind goes, oh my gosh, the market's down. If I'm taking money out of my portfolio, I need to shut all of that off. I don't want to run out of money. I don't want to see it go down to zero. And this could be for whether you've got $500,000, $1 million, $2 million or more. It's just how the mind thinks. But instead, if you know where you need to make adjustments, we're not shutting off the faucet. We're just making tweaks to it. And maybe instead of taking out $5,000 a month, you need to take out $4,700 a month. So do you know where to make adjustments and what those adjustments are? And not only adjustments of reducing your income, but when the market goes back up, do you know where to make the adjustments to take more money out? Because otherwise you're just leaving a mattress full of money, right, for your beneficiaries. So you need to know on both sides where to make the adjustments down, but also where to make the adjustments up, because you worked hard, you saved hard, you might as well spend and enjoy it as well. And a lot of emotions come from just what we're talking about, which is volatility. So a question you have to ask yourself is volatility normal or should it be avoided? In my opinion, volatility is normal. If you're going to be investing in the market to help support your retirement, volatility will be normal. You're going to see it day to day, week to week, month to month. However, if you look from years to years, you're going to see that volatility wasn't as big of an impact as what you may have thought. But day to day, month to month, it can definitely play on the emotions. But it is normal. It's part of investing. It is normal because we're going to have equities because we need to make our money last. We need to outpace inflation. So when it comes to that, volatility, it is normal and we need to plan on it for the future. But back to your strategy, instead of focusing on these day-to-days and these month-to-months, focus on those strategies, that income plan leading to your investment plan, and then also knowing when you would need to make an adjustment. That's what we call the income guardrails. Last but not least, I think it's important to talk about opportunities. What kind of opportunities do we see or does volatility cause when the market's down? So think about right now a few opportunities. The market is still down, right? The market's still depressed. So I see a few opportunities here. For those that are still working, a down market is a buying opportunity. It is an opportunity to buy investments while they're on sale. I always use a simple analogy here. If you were staring at two stores selling the exact same TV, and the store A had that TV for $500 and store B was selling it for $800, where are you going to go? Well, you're going to go to store A to buy the TV while it's on sale. Same thing with the market here. The investments are on sale, especially if you feel like they'll be higher in the future like I do. And so you take advantage of that buying opportunity. So how can you take advantage? Well, dollar cost averaging into investments, so automatically contributing to your investment accounts. If you have a 401k or an IRA, now might be the time to continue to invest in those, but maybe you want to up your contribution while the market is down, taking advantage of investments while they're on sale. Now, for those of you that are retired, there's also opportunities in a down market. One of the opportunities that you might want to look at is should you do a Roth conversion, paying tax on your IRA dollars today, shifting them over to the Roth IRA where they will grow tax-free and you can withdraw them tax-free. Back to our, quick little sample here. If you feel the market's going to be higher in the future than where it's at today, well, then would you want to pay tax on a lower amount, shift that money over, and then let it grow in the tax-free bucket that also allows for tax-free withdrawals. So instead of getting hung up on volatility and market predictions and what might happen tomorrow or this month or next month or the first quarter or the first half or the second half of the year, let's focus on opportunities, let's focus on strategies, and instead of focusing on that market day to day, focus on your strategy, enjoy your life, enjoy whatever you're doing today, enjoy whatever you're doing tomorrow, and if you're in retirement, enjoy your retirement, know your strategy, know your guardrails, so that way you can just go day to day and not have to look at what the headlines are saying, not have to look at what the market is doing, and just truly enjoy your retirement. I hope you found today's show to be of value and benefit, and if so, subscribe on your favorite podcast player. Also, if you're not getting our weekly emails, go to lifemoneyshow.com, scroll down, and sign up to be on our insiders list. We have new emails that come out each and every week to help you reduce your long-term tax burden and understand how to invest and retire with confidence. I look forward to our next conversation to continue to help you enjoy life today and be financially confident about your tomorrow.
Investment advisory services made available through AE Wealth Management, LLC, AEWM. AEWM and Searns Financial Group, Inc. are not affiliated companies. Insurance products are offered through the insurance business Searns Financial Management, Inc., Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc. Bond obligations are subject to the financial strength of the bond issuer and its ability to pay. Before investing, consult your financial advisor to understand the risk involved with purchasing bonds.